year 2025 has been wild for anyone importing goods from China. Freight prices have moved up and down like a roller coaster. This has made business planning very difficult for many companies. 1 month, the cost to ship a container was very high. A few months later, the price dropped sharply. This essay will explain why this happened. We will look at the timeline of events that caused these big price swings. The main cause was the trade relationship between the United States and China. Their policies, tariffs, import taxes, created a lot of uncertainty in the market. This led to big changes in shipping demand. This situation is often called the 2025 China shipping crisis. It is not a crisis of ships being stuck like in the past. It is a crisis of price volatility and unpredictability. In early 2025, the United States announced new, very high tariffs on Chinese goods. This made importing much more expensive. The shipping world can be complex, but step by step the reasons become clear. By the end, you will know what happened and what you can do about it. Freight prices shot up in May 2025. It was a sudden, massive rush to ship goods. That rush was triggered by a political decision, a 90-day tariff truce. United States, China. A long dispute with high tariffs on many products. In early 2025, average duties reached around 65%. For 90 days, those high tariffs would not be collected. A brief window to import at lower cost. The truce created front-loading demand. Businesses rushed to avoid the tariffs. They placed orders and booked container space leaving China. They wanted inventory into the U.S. before the window closed. Demand surged, fast. Bookings rose more than 4 times in a short period. Everyone tried to ship at once, competing for limited space. Demand hit limited supply of ships and boxes. Carriers could not add vessels instantly, so they raised prices. Spot rates skyrocketed. A 40-foot container near $2,500 jumped to over $9,000 on popular routes. Importers paid up because it still beat paying massive tariffs. Just as quickly as rates spiked, they began to fall. Panic buying in May and June cooled. Warehouses were full. New shipments could wait. Shippers waited to see what tariffs would do next. New bookings dropped sharply. Overcapacity reappeared. Too many ships. Not enough cargo. Carriers competed by cutting prices. In Q3, rates fell for 11 straight weeks. By October, a 40-foot to the U.S. West Coast was about $1,431. A huge drop from the May peak. The market was correcting. Global demand was weaker than the spike suggested. Falling demand plus persistent overcapacity drove prices down. Relief for importers, but volatility was extreme and unpredictable. Understanding these cycles helps importers plan smarter in an uncertain market. Shipping lines run very expensive fleets. They cannot afford half-empty sailings. To stay profitable in a volatile market, they manage capacity and costs. They operate fixed routes called strings in predictable loops. They remove ships or blank sailings when demand is weak. During high tariff periods, many vessels moved off the China-US lane. When demand surged in May, repositioning back took time. That delay tightened space and raised prices. Carriers act on long-term projections, not short blips. After the rush, blank sailings return to support rates. Cancel too many, they lose customers. Cancel too few, rates sink below costs. Rollovers add uncertainty even when prices look low. Reliability matters as much as headline price. Expect carriers to protect profitability with service cuts and blank sailings in weak, unpredictable markets. The shipping crisis of 2025 was not just about tariffs. Other global events added instability and cost. Since 2024, Red Sea disruptions pushed carriers off the Suez route. Detouring adds 10 to 14 days to voyages. Costs rise, more fuel, longer time, pass through as higher rates and emergency surcharges. More time at sea means fewer voyages per year. Capacity tightens. Europe felt it most, but ripples spread globally. Tariff shocks redistributed global flows. Europe, Japan, and Korea absorbed some capacity during the trade war. If tariffs ease, a rebound could send cargo back to the U.S. A sudden rebound could overwhelm West Coast hubs like Los Angeles and Long Beach. Severe congestion could return, ships waiting days, terminals piling up. Importers risk demurrage and detention fees amid delays. Retailers and e-commerce feel these bottlenecks first. Navigating this volatile market can feel overwhelming, but importers are not powerless. Plan ahead. Do not wait until the last minute to arrange shipments. Build extra buffer time into your schedule. Communicate regularly with your supplier and freight partner. Stay flexible on routes, carriers, and ports. Consider alternate ports plus trucking or rail when faster or cheaper. Get multiple quotes to benchmark prices. For small, high-value goods, consider air freight during ocean delays. Inspect goods before shipment to avoid costly defects downstream. Buy cargo insurance. Add coverage for war and diversions when warranted. At Yan Sourcing, we help you source, inspect, and ship safely and cost-effectively. From factory verification to door-to-door delivery, we keep you moving. Do you have any questions about the import process? Visit our website yansourcing.com or send us an email at info@yansourcing.com. I'd love to help.